Top 7 Ways to Survive a Recession in 2023. An economic decline that lasts for a little time is called a recession. If a nation's gross domestic product, GDP, has seen negative economic growth for 2 consecutive quarters, that nation is said to be in a recession. Unemployment, job losses, business closures, dropping earnings, little commerce, poor industrial activity, etc. may occur in an economy that is experiencing a recession. But before we move on with the video, support the channel by liking this video and subscribing to this channel for future updates. Number 7. You find it difficult to look at your retirement account. You are aware of your declining worth. A crucial indicator of market success, the S&P 500, has seen almost a fifth of its value decline. Many of 401 participants were forced out of the Millionaires Club due to economic chaos. Unsurprisingly, several Bitcoin businesses went under, wiping out billions of dollars in investments from common investors like pension funds and individuals. And you keep hearing that a recession is imminent, or that one may already be underway. When you consider how difficult the Great Recession was for so many people, being told to cool down, or that this too shall pass, is not likely to ease your concerns about your financial security. Don't be concerned about a bear market. Even if you have no idea what a bear market is, you are already prepared to be terrified of one. When a significant stock index declines by 20% from its most recent high, it is said to be in a bear market. In mid-June, the S&P 500 entered a bear market. Number 6. Bear markets don't endure forever. So keep that in mind. According to Anthony Saglin, global market strategist for Ameriprise Financial, since 1950, they have generally lasted 14 months on average. If you're a longer-term investor, just adjust your perspective a little and see this as an opportunity. Concentrate on businesses with solid cash flows, healthy balance sheets, and goods that customers want and need, he advised. Healthcare and consumer staples industries have frequently performed well in recessionary conditions because people need their products regardless of the economic environment, according to Christine Benz, Director of Personal Finance for Morningstar. It's a terrific time to use dollar-cost averaging, in which you consistently invest the same amount of money regardless of market ups and downs. Avoid attempting to time the market. Many people might wish to stop investing in the stock market or cut back until conditions improve. That is what it is to attempt to time the market. It's impossible to predict when it's best to exit a situation and when it's best to return. Most people, most ordinary mortals, are unable to time the market, according to Mark Hamrick, the economic analyst at Bankrit. Warren Buffett would acknowledge that too. Stock returns for the S&P 500 often outperform the market until we hit the bear market's bottom point, according to Saglin. When you're in the midst of either a recession or a bear market, you don't want to make outsized allocation modifications until the dust settles, said Limbeen said. This is one of the things we constantly tell investors and advisors to do. If you have a balanced portfolio, you can weather the storm. Trying to predict the market's bottom at this time would be the worst thing an investor could do. Number 5. Pay off whatever credit card debt you have. Matt Scholes, the chief credit analyst at LendingTree, stated that paying off credit card bills as quickly as possible should be everyone's priority. It's even more crucial when there is a chance of a recession and interest rates are rising quickly. Taking a low-interest personal loan or applying for a credit card with a balance transfer are 2 options for dealing with debt. If you transfer high-interest debt to a credit card with a 0% APR, you can get out of debt much more quickly. Scholes advised contacting your current credit provider and requesting an interest rate decrease if you couldn't be approved for a credit card with a 0% interest rate. Almost 70% of those who requested one in the previous year received one, but too few people inquire. Number 4. Build up your funds. Because a recession can swiftly alter your situation, save while you have the extra cash. If you don't have a sizable emergency fund, you might want to postpone an expensive renovation project that isn't necessary or cancel a scheduled vacation. Despite signs that inflation may be slowing down, the Federal Reserve has indicated that it intends to keep raising interest rates. If you lose your job, You don't want to fall back into debt. Moreover, keep in mind that the conventional wisdom of keeping 3 to 6 months' worth of living expenses on hand may not be sufficient. According to their circumstances, workers should appropriately size their emergency reserves, according to Benz. Younger workers might have more lifestyle flexibility, allowing them to take on one or more roommates or change careers to take advantage of new job prospects. She explained that this will allow their emergency reserves to be closer to the 3 to 6 month range. But on the side of having a year's worth of savings or assets, you can quickly liquidate if you're an older worker who can't alter your living situation, or if you are in a highly paid specialized position where replacing your income could take longer if you lose your job. Number 3. Create a reserve for your emergency fund. In addition to establishing a rainy day fund for the recession, Benz advises researching potential sources of additional funds in case you suddenly required them. It's ideal to apply for a home equity line of credit when you're employed and most likely to get approved in this situation, she said. Number 2. Bonds can be a powerful component of your retirement plan. Bonds typically offset your stock holdings when stocks are down. Yet the bond market has also experienced turmoil. But as Benz noted, bonds have fared better than almost any other market area in previous recessions. She explained, in other words, don't toss them overboard just because they're not performing well now. They are a crucial component of any portfolio, particularly for those approaching or in retirement. Number 1. Take on a side job. Numerous businesses are asking for employees. According to the Bureau of Labor Statistics, the economy experienced job growth in the areas of government, healthcare, and leisure and hospitality near the end of 2022. At 3.7%, unemployment was prevalent. Yet, Hamrick acknowledged that there was a chance that unemployment may increase. The media and technology sectors have seen a substantial amount of layoffs. Even if you aren't in immediate need of cash, now may be a good time to start looking for a second job or work in the gig economy to increase your earnings and savings. The moment has come to plan for the worst while holding out for the best. That's it from this video. Let us know if we miss out on any point in the comment section below. If you enjoy this video, please like it and also subscribe to our channel. Thank you.